Welcome back to the Capital Mindset Show. This is part 2 of the debate between Peter Schiff and Ross Gerber. If you haven't checked out part 1, I'll have it in a link in the description below if you guys are curious. Now, here we go. We're on to part 2.
He's buying bonds right now.
I remember when I was shorting the subprime mortgage market and advocating that people do that, and we were living in a housing bubble, and people own these mortgage bonds, and people said, well, why are people buying them? Why are they paying par? I said, because they're fools. They have no idea how much money they're about to lose. People are on the precipice of historic
There's a lot
losses.
of people in the treasury market.
Look, people are going to lose a lot of money that don't understand this, and even the money they don't lose is going to lose a lot of value. So this is going to be a game changer for a lot of people who can't read the writing on the wall and don't understand the bubble nature of what we've just experienced, and where we're headed is reality. And reality is going to look a lot different than this fantasy.
Well, the S&P is actually trading at its historical PE right now.
Yeah, but when we see the dollar crash, right, and a loss of reserve currency status,
the dollar's rallying right now.
If this is its swan song, it's rallying on this flight to quality over what's happened.
It's because America's the best game in town, my friend.
It's not the best game. You play that.
We are. We're the best game in town.
We're the biggest debtor. We've got the biggest trade deficits, the biggest budget deficits. We've got the biggest bubble economy. We're being supported by the rest of the world. And the rest of the world is going to withdraw that support, and our economy is going to implode. And if you don't understand that, well, you're going to go down with the ship.
Haven't you been saying this for a long time?
Yeah, I've been saying it for a long time, and I've been right.
All right, so I'll pause there. Ross Gerber's kind of right. The United States is one of the best games in town. There are a lot of bad games in town. Let's just say that. But then Peter Schiff is also right, because the thing that Ross Gerber is kind of not touching upon is that the reason why the United States is such a good game in town is because of the world reserve currency status. So the other thing about Peter Schiff saying that if it were to lose that status, yeah, that would be there would be a lot of complications within the United States. One could probably use their imagination to kind of figure out what, but it's very difficult to remove or unentrench oneself in a monetary system like the Eurodollar system. The Eurodollar system is so intertwined everywhere that it would take quite some time. We would probably see it happening beforehand. And of course, I guess the normies won't see it until all of a sudden it were to occur. But there's no signs right now that it's weakening a lot. Okay, it's not. You could say that there are reasons to be kind of bearish on it longer term, but nothing that says, oh, in 5 years from now, we're going to be off of it and the world's just going to say, I don't want dollars or whatever, something like that. So then that goes to Ross's point. So I'm kind of trying to give them both points here, but yeah.
The economy still hasn't imploded.
But all the problems have gotten worse. So it's going to be an even bigger implosion.
Let me jump in here just to summarize a couple of points, because I think there's been an incredible amount of important points that have been made here. So first, obviously, the Fed balance sheet now a little under half of U.S. GDP at about $9 trillion. U.S. GDP around $20 trillion right now. Second important point, there's this core, I think, disagreement between you guys on the merits of the facts about this point. Ross makes the point that inflation is cured by recession. Historically, when you see recession, you see declining prices. Peter makes the case for a 1970s style stagflation type environment, whereby you have this, Ross also making this case almost that the U.S. is the cleanest shirt in the pile of dirty laundry. Peter Schiff sees a dirtier pile more generally. Let me go first to Peter and then back to Ross. In terms of that summary, how do you respond to that notion?
Which notion?
Well, the idea that first, the Fed balance sheet is a substantial problem, and second, that specifically that recession is not the cure for inflation and that we may be moving into a stagflationary environment.
The balance sheet is a huge problem, and it's something that I predicted. When the Fed first made the mistake of doing quantitative easing, I said that we would be here. I predicted a $10 trillion balance sheet back then, and we're almost there. When the Fed did the first QE, I said they would never stop. There would be QE2, QE3. I said we'd have more QEs than Rocky movies. When Bernanke lied to Congress and said he wasn't monetizing the debt, I said, no, that's exactly what he's doing. Bernanke pretended that the government buying bonds was temporary. I knew that it was permanent, because once you start this drug habit, you can never give it up. And the more drugs you take, the more you need, because you build an economy that's even more addictive and more dependent on that drug. That's why we can't take it away the way Volcker did to fight inflation. We're going to overdose on this monetary heroin, and the real risk is a hyperinflation. And the economy is going to go through a protracted decline. And what a lot of people focus on inflation and recession is they think about, oh, well, demand goes down during a recession. Well, supply is going to go down even more when the dollar crashes and all those goods that we used to import aren't coming in anymore. I mean, imagine all the shelves that are completely empty because we can no longer afford to import the products that used to fill them. Then the products that we do make are going to be exported, because the dollar is going to be so low that whatever we do make, somebody in some other country is going to outbid somebody in America. So even though Americans are broke and unemployed, prices are going to be going through the roof because of the...
So he's not wrong on that stuff regarding just like basics Austrian economics right there. So he's right. He's actually going off of some pretty basic economic principles that you learn in your macroeconomics class. So as the currency, if the currency were to in theory collapse, so to speak, you would have a situation where if the United States doesn't produce things, it'd be very difficult to import them. But then at the same time, it would be easy to export because relative to other currencies, the US dollar is weak. Now, remember that in the part one of this series, I discussed how Ross Gerber and Peter Schiff are kind of combating each other on a whole other battlefield that I don't think is appropriate necessarily, because they're making a host of assumptions. For example, the two of them do believe that we are printing money, or at least I'd like to think that they're using that vernacular, or at least Peter Schiff is, in order to kind of oversimplify it for the average person who watches his content, right? Because it's easier to explain it that way than to actually explain literally what is going on, which we've discussed over and over and over again on this channel. So again, just a refresher, it's an accounting move that the Federal Reserve does with the banks, and there's actually no new money being created. It's a far more complicated measure than that. And my personal opinion is that, in essence, what we're going to see is the United States is going to enter kind of a Japan-like state. Growth will continue to decline below trend line. So we are way below trend line, and we've discussed that in the past as well. So the amount of potential economic gain that has been lost over the past, I'd say, 20 years is equivalent to almost an entire other United States economy. But regardless, it's actually manifesting itself in a whole host of problems that people are correctly identifying, but no one is perhaps ascribing the right prescription to it because they can't even identify what the disease is. So the disease is far more pervasive, and so we're just seeing the symptoms, and we're all debating each other as to what is the cause, I would say. And the solution would probably not be to do more of what we were doing. So that'd be like something. So all else aside of what we've discussed of what the disease most likely is, doing more of what we were doing before probably is not going to help the disease kind of go away. All right. And so I personally do not think the United States is at the point of risk of hyperinflation. Again, I think what's more at risk is further decline of velocity, further decline. And by the way, velocity can still go lower for the United States. We've actually shown the data that the United States still has a higher velocity than other developed nations or developing nations. So we're not there yet, but we can get there. So again, I'd agree again with Ross Gerber that United States is a cleaner shirt in a dirty pile of laundry, because when Peter Schiff, I think some of his investments, he focuses on Europe, but the problem is Europe is a dirtier shirt in a lot of cases. So you can isolate certain countries out of Europe. And I've had discussions with some of you who are European, who seemingly thought that and I apologize for this, but seemingly thought that I was painting a broad brushstroke on all of Europe and saying, no, there are pockets of Europe that are doing really well, but there are a lot of parts of Europe that are not doing so well. And you can measure this in a variety of different statistics that show you the health of the consumer, the ability for the consumer to spend. Of course, you might argue that the quality of life there is better. I've heard that argument, but arguably, it's not arguable that it is becoming less and less sustainable, and so these are problems that might take some time. I've actually discussed with someone in person while I was in Europe, actually, and they said, "Well, it will be good while it lasts, and we'll make it last." And I was like, "Oh, okay, that's a good, interesting perspective," because they were saying that they won't be around to see what the consequences, because they admitted that there are going to be the consequences, and actually they fervently believe that, but they didn't really care too much because they won't be around for it, and they didn't have kids, which was funny. But on that note, let's continue.
The weak dollar and our lack of domestic production. So it's going to be not just stagflation. I've been saying it's a inflationary depression, right? We're going to have the economy of the 1930s, but worse, with the inflation of the 1970s.
So when you're discussing with someone, it is not prudent, it is not good in practice to just laugh at what they say. So I just want to highlight that Ross Gerber in part 1 and in part 2 has been laughing at Peter Schiff. And regardless of anything about disagreement, you should never, ever, I think, you should always be cordial with the person you're discussing with. You should never laugh at their statement and say, or say that they're wrong because they're stupid or anything like that, right? You should actually attack the points that they're making and then just leave the whole childishness to the side. But what do I know? Ross Gerber is probably double my age, so he's older than me, so he's probably correct.
70s, but worse. So that's where we're headed. Now, there are solutions to this. I mean, none of them are painless, but they involve dismantling most of the federal government, returning to free market capitalism and sound money. And, we could eventually dig our way out of this hole. I mean, capitalism is a fantastic tool if we can unleash it. But what we've been living under is not capitalism. And the disaster that we're headed for is not a function of capitalism, but socialism. We did it to ourselves with central banking and central planning.
Ross, your response.
Wow.
I'll respond to Peter after I hear Ross's response.
I'm not bringing Peter to any parties, man.
Well, I'm fun at parties. No, yeah.
Useless comment.
This doomsday scenario, predicating the rise of Nazi Germany is pretty much what you just described.
Well, who's talking about Nazi Germany?
Yeah,
you mean?
Well, you just described the 1930s in Germany environment, and I don't think that that's what we're going to here in America.
Well, that's the 20s. That's the balance sheet. Weimar Republic. I'm talking about the 1930s in the U.S.
As far as the balance sheet is concerned, it's a really troubling reality, the role the Fed has come to play in our economy due to, I think, many reasons that are self-serving. And the best thing we can do right now is lower the balance sheet of the Fed, because that will also have the same effect of lowering the inflationary pressures that we have by actually having the Fed get out of the long side of the bond market and letting those rates rise as they need to cut demand.
Right, but that creates a problem, right, for all the debtors when interest rates go up.
It doesn't create a problem at all if you do it in an orderly manner, because the demand for bonds is still huge right now. People are buying bonds at 1 3/4 yields, even with your 7% inflation.
That's because the central banks are buying.
If the Fed has that demand for bonds, they should use the opportunity to sell off their balance sheet in an orderly manner so that they're not manipulating the long rates anymore. So what I see the Fed needing to do is this combination of actually exactly what they're going to do, which is slowly raise interest rates and slowly peel off this balance sheet so that you're not pulling all the drugs out of the party at the same time. Okay, we need the methadone treatment to get off the Fed stimulus situation, but we have a very strong economy right now. It's as strong as I've seen it maybe in my life. I have not seen the demand for everything. Like, it's amazing demand, whether it's Disneyland or a house in Puerto Rico for spring break. I would love to get a house in Puerto Rico for spring break. If you can find me one anywhere on your damn island for rent, I am there. That is how much demand is out there in the United States right now. So we're at the beginning of a boom, Peter, a huge boom. So
all right, so Ross Gerber, I guess he doesn't have access to the data that we've been talking about for a while. For all his wealth and resources, he didn't have access to that data. So this was filmed on March 29, 2022. Today is June 5th, 2022. Now the jig is up. But again, no excuse because the data was there. You just had to have looked. I'll just change this look because, oh, that looks even worse. All right, that looks better. Looks more serious because I don't like to pause when they look bad. But well, I'd say that Ross is using a lot of anecdotal evidence, and when you use anecdotal evidence, you're going to get equal in fact to the quality as far as a result. So I think that, obviously now you can point, a lot of people will say, okay, he's wrong. But back then people would have defended him. People would have said that, the stuff we were saying was wrong, even despite showing the data or discussing the different parts of the economy that would be canaries in the coal mine, so to speak, as to what it was to come that is currently underway. And now the tune has changed, which is why it tends to be that I am starting to change my tune. So it's because now that it's being discovered, so to speak, it's kind of late to the game. And so Ross is probably, if you ask him today, he's late to the game. Okay, so he had no excuse. He should have been early to the party, or at least somewhat early to the party. So as far as what Peter Schiff was saying, I will say that he is going a little bit exaggerated. Well, not exaggerated for the scenario in which he is describing, because you got to understand, and I said this in the first video, if you operate from his axiomatic understandings of how the economy works, or how, not the economy works, but the Fed specifically, how that works and how QE works, then yeah, what he is saying would be the result of that. But the thing is that that's not exactly how it works. It's more complicated than that. And even Ross Gerber here doesn't actually do a good enough job at describing exactly what happens. So he's saying, lowering the balance sheet, and it has all these extraneous effects, right? But that's not necessarily how that even works, right? And they don't even probably understand that the Federal Reserve doesn't even choose, for example, it doesn't decide the FFR rate. It decides a range for the FFR rate. And that's usually what they've been discussing, right? They've been discussing the Fed's ability or effect on yields, right? Aside from QE, right? QE is a separate process, but it's kind of, I don't know. I'd say that there's a lot of nuance just missing from this conversation. I kind of conclude the same thing as part one, that they are fighting on a different battlefield that I would like it to have. I would love, how I would love on here? I would love actually Jeff Snyder to come in here in a three-way debate here. But yeah.
United States right now. We're at the beginning of a boom, Peter, a huge boom. So get used to it, my man. And there's inflation when there's growth. And that's not bad either. It's not bad to have inflation if you have a massive growth. The economy's growing 6-7% right now. Never happened.
Oh, I'll pause there. Oh gosh, it's happening again. That's actually blatantly false. You don't actually need growth and inflation. They're not exactly married to one another. You can find instances when there is growth and inflation, but you can also find growth and deflation. That's actually something people don't know. So from the era of the 1800s, late 1800s to early 1900s, there was actually a decent amount of deflation. People don't know this, but the U.S. economy actually grew, because you have to always measure things on a real term basis. And, yes, they've kind of discussed this already. Technology is deflationary. And Peter's right. Market-based forces are deflationary. Market-based forces will eventually provide to the consumer their demands with supply, right? And then over time, there's always the incentive in a market-based system, in a capitalist system, to lower those costs over time. And in that sense, you do experience greater standards of living, greater standard of living, greater standards of living. And you've noticed it. You are the product of such a mechanism today, if you're watching this on anything. And these are phenomena. They're not actually, they're not theoretical things. They're just observable phenomena that occur. Market-based forces exist like a part of nature, okay? And then we as humans, we kind of either accept it or fight it regardless. But what Ross Gerber is saying is patently false. I have to come in and say that. He's basically marrying inflation with growth, and that's not necessarily true. See, that lacks a lot of nuance, and it lacks a lot of historical context right there. So, but I get what he's saying, because you will find instances of inflation and growth, but just because you do find instances of inflation and growth does not mean that there's causation. Correlation in an observation does not mean causation. You probably remember that from your statistics class. But someone did not remember that from their statistics class.
Have a massive growth. The economy's growing 7% right now. Never happened. Never happened.
My house in Puerto Rico has gone up 7x since I bought it a few years ago. So yes, it's a bubble. But what you're talking about right now,
it's not a bubble. I can't find a house in Puerto Rico anywhere.
Data is in. It was a bubble. Data is in on all the housing market. It is slowing down. So I have to put in here, because Ross Gerber, why would you say such a, why would you be so, why would you die on this hill? That's such a silly hill to die on. That's my only comment on this, only because we're filming this on June 5th. Of course, I feel like I have the right to say that too, because on March 29, 2022, I was already definitely saying this, and even before then, we were talking about this. So I feel like I have the right to say that, but like, it's just fascinating that, you know, he has so much resources. He's supposed to be so in tune with the market. He just didn't see that. Now, I'm not trying to give Peter Schiff points here. Remember my criticism of what he's saying. I'm harping down on Gerber here, because he just said something that's
what you're talking about,
and it hasn't aged well. It aged like fine milk.
Right now is not growth. Right? This is a bubble. If we had a strong economy, we would have trade surpluses, not deficits. You know,
no, we buy our stuff from China.
Because our economy is too weak to produce it. This is a gigantic.
No, we don't have. Have you ever manufactured clothes in LA before? It costs 5 times more. It's called globalization.
This is the weakest the U.S. economy has ever been. That's the reality.
What he just said, it almost like it escaped him. So they're arguing on two different fronts, by the way. You can see that Peter Schiff judges the quality of an economy by its ability to produce and output. Its output is the quality of the economy. Gerber kind of comes in and says, I don't think, like, Gerber's not fit in this debate right now, because they're not arguing on the same level. Okay, they're arguing on two separate levels, and so it gets a bit confusing, because you can see that it kind of went right past Schiff's point, and I think Schiff is able to see what Gerber's points are, but I don't think Gerber is able to see what Peter Schiff's points are, or he's not able to see what are his axiomatic beliefs in terms of, you know, versus like his Austrian economics background. Okay, so. Peter is coming from the perspective that an economy's quality, and I'm not saying this is correct. This is blatant fact that he does believe this, that the economy's quality comes from its economic output. So its output, its productive output or productive capacity. And Gerber comes in and says, well, no, we buy it, like, as if this refutes the point. You see the confusion. He's saying this point refutes Peter's point, because this is a debate. He says, in order to refute your point, I'm going to point out that we buy all our clothes from China, or we buy all our goods from China, as if that refutes the point or the premise Peter was making. That is separate from the fact that Peter is correct or not. So it's like me saying this house is on fire, and the house might, let's say the house isn't on fire, but I say this house is on fire, therefore it is hot. And then you come out and you say, as a counterpoint, that house is not on fire, or sorry, that house is on fire, but it's not hot. That's basically the argument is happening. What's happening here is like the house is on fire, but it's not hot, and I'm saying the house is on fire, but it is hot. And then so there's nothing really being refuted there, and I could still be wrong about the house being on fire. So that's what I'm trying to highlight there. Yeah, I hope that made sense, but I tried.
We are bleeding red ink. We are living on life support.
You need to get off the island, my man.
No.
Come to LA. Come to LA. You can't get a reservation
I was just
anywhere.
in LA.
You cannot do research on anecdotal basis, right? You cannot. And by the way, if you want to say that, well, the data was showing, no, the data was not showing that. The data was not showing that. Otherwise, we would have been saying that the data was showing that. Nope, the data was not showing that. The data was, in fact, showing that we were going through a liquidity crunch, or the beginning of a liquidity crunch, and that would or could have manifested in consumer spending. Now, you might see that consumers were spending a lot previously, but oh yeah, they're going to feel that. And then especially when we saw Walmart report, when we saw Target report, we got a glimpse of it. And we saw that in Walmart's reporting, a lot of consumers, the tickets were actually declining. So, you know, again, you might think that we have the advantage of filming this later to see how much Ross was actually incorrect. And if we were to ask him today, he probably would say a different tune. But my point is, he had access to publicly available information to come to these exact same conclusions, but yet didn't. And that's a bit of a problem. Now, Peter is a bit on the other end, and let me criticize Peter here. Peter believes that we're going to enter hyperinflation, which I personally disagree with that. But you see that I'm separating the two. Like, if we enter his arena of his, I guess, core facts being correct, then I would say, yes, we would enter into hyperinflation. But my point is, I believe some of his core facts, not all of them, some of them are incorrect. His analysis of if those core facts were to be true are in fact correct. I will say that. But I think his core facts are incorrect. And then so that makes it that his prediction will end up being incorrect. And maybe if he continues the same prediction, eventually his prediction is going to be correct. Does that make sense? I hope that makes sense.
I'm telling you, you are living in a fantasy land, and you're about to meet the reality of a pin.
It's a wonderful fantasy land that's busy. The traffic is stopped everywhere, even with gas at $7.
Go and look at the ports. Look at all this stuff that our weak economy is incapable of producing. It's the strong economies.
We have a backlog of ships coming in.
See, that's exactly the same thing going on. You see? That's what I'm saying. Peter's saying the house is on fire and it's hot. Ross Gerber's saying the house is on fire and it's not hot. So they're not arguing whether or not the house is on fire or not. They both agree the house is on fire. I don't know what to say to that, but like, yeah. You see, he's saying like, that it's a bad thing that we have all these goods coming in where no goods are coming out. And he's like, it's great. So many goods are coming in and no goods are coming out.
Those ships, those are foreign ships, foreign flagged, foreign built, full of products that foreigners made, and they go home empty because our weak economy produces nothing. This is the biggest bubble in the history of the world, and you have no clue.
We don't produce nothing.
Peter, you got to come visit me.
See, we don't produce nothing. That's an exaggeration. We don't produce nothing.
Come visit me. I will show you the economy. It is unbelievably good.
What are you going to show me? Restaurants where people are eating?
I'll show you the whole city. The whole city. Everywhere you go.
Yeah, you want to see it? You got to go.
Guys,
to the countries
we should do a mutual tour where Peter goes to LA, Ross goes to Puerto Rico. It'll be lovely.
He can't afford Puerto Rico though. It's too expensive.
I can't. There's nothing for sale. It's all sold out.
Look, I got a condo.
Hotels,
I might give you my house for $60 million. I don't know. I'm thinking about it. My condo. I got a small condo.
Okay, so the reason why Puerto Rico is so desirable to go to is because of the tax structure over there. So I want to go to Puerto Rico. I have to convince my wife we can go to Puerto Rico because if you have a lot of, if you can produce a lot of income through your assets, and you can manage to live in Puerto Rico, or you can work from Puerto Rico, you're going to be doing pretty good. So Puerto Rico, I think, has a wonderful tax structure, or wonderful tax policy, and I think it's what's actually driving a lot of the growth there, if I'm being honest. Aside from the fact that their local government is rather incompetent in some areas, they're at least understanding that in order to drive economic growth on the island, they must actually attract capital. And they're doing a fantastic job of that so far. But they have to actually then tap into that and kind of provide the proper incentives for proper development. But yes.
You guys
get
paid
for $25 million.
You get real power.
Let me ask you guys this question here, because we've had a great conversation over the last 50 minutes or so, but I want to bring it back to the core.
We should do that. It would be such a good show if Peter came to LA and I went to Puerto Rico and we did a tour.
I would love that. I want to host. So let me just ask you guys this question to relate this back to the core conversation we're having here. I think we've actually quite clearly heard two very distinct views of where the U.S. economy is. So tie it back, Peter and Ross, to this idea of value versus growth stocks. How does it fit in with the thesis? First to you, Ross.
Well, first of all, value stocks are now expensive. So, value kind of became growth now. And so you have the opposite with oil prices at 120.
See, I despise that definition. That statement didn't even make any sense. Like, value is now growth, growth is now value. No. I mean, that's why I don't like those definitions. They make no sense. They're used in the textbook often. So I call that the textbook definition of value, the textbook definition of growth. But I think if you kind of pigeonhole yourselves to those definitions, you're going to do I don't know, yourself a disservice than anything.
25 and Exxon and all these companies going through the roof, they're not actually cheap anymore. And all the tech stocks that we own in clean energy is actually really inexpensive relative to their growth rates. So it's actually, I think, a wonderful time to look at your portfolio and rebalance depending on what you own. So, we don't own oil because ethically it's like the worst thing in the world. So, but we do own gold and other commodities that have done very well. And so, now we're looking at shifting out of those back into our tech names. And so I think with every portfolio, you want to have a balance between growth and value too, but we still look at earnings growth and what we're paying for that growth. And so I think this is a great time for investors to assess stocks like Google, for example, which when you look at the PE to growth rate are extremely attractive.
Can't hate on him there. He likes my stock. Okay.
If you want to be in the technology sector. And at the same respect, if you're in the commodities business, this is as good as it gets with us banning Russian oil and a whole war. So you maybe want to take profits like Carl Icahn did selling his Oxy stake this week, which was super smart, made 1.5 billion. So I think it's a good time to maybe sell your value.
So I've got a great Peter Schiff question. Peter, the question to you is this: why value stocks and not gold? Why not shotgun shells and Krugerrand if the world looks this ugly?
Well, you should have some ammunition stored up and some food and things like that. But that's, how much money can you invest in ammo? I mean, the prices will probably go up. On my podcast for the last year, I was advising people to go stock up on toiletries and, anything that you would need, because I thought prices were going to go way up. And now you can see a lot of these, products are up 20, 30, 40% over last year. So it's not a bad investment. But, there's only so much shampoo and shaving cream you can put in your medicine cabinet. So, but as far as, value and growth, first of all, a lot of these growth stocks are still not cheap. I mean, they've come off their highs, so you can say some of the froth is out of the market, but not enough. I mean, there's still too much complacency out there. Again, you got Kathy Wood claiming she's a deep value manager. I mean, I'm waiting for her to be out of a job before I start looking at some of these stocks. They got a long way to go. We're going to have a lot of bankruptcies in the tech sector. Remember, a lot of these companies have never made any profits. They've been funding their losses by selling stock. That's going to go away. So there's a lot more downside in that area before it really becomes attractive. I agree that some of the value stocks were picking up prices prior to what just happened. But we've seen a pretty good move down in the last week, particularly in Europe. A lot of these stocks are now very cheap as far as I'm concerned. I mean, not the material, the commodity ones that are going up, because obviously there are some winners and losers.
Like LVMH, for example.
But there are companies where the stock price has discounted a far worse outcome that it's even possible. I mean, other than maybe, a nuclear war. And of course, if we have nuclear war, then none of this matters. But if you look at what's been factored into a lot of these stocks, I think that they've more than compensated for the worst case scenario. So I think there's good values right now in a lot of these dividend paying value stocks. But I think that they're going to become even better values as time goes on, especially as inflation really picks up. Because the companies that you want to own in an inflationary environment are the companies that have the pricing power where the consumer is going to keep buying even if the prices are higher. They're going to cut back on other things.
So you mean Tesla? Because Tesla has pricing power and it cuts people's cost of living.
Oh my gosh, that did not age well. A lot of things have not aged well. Of course, a lot of Peter stuff might not age well too, but we have to kind of wait, because I'm not going to claim that it won't age well, because I could be wrong and then he could be right, that this is the hyperinflationary moment, and then okay, cool. But we can kind of definitively say that a lot of Ross Gerber's points throughout this debate have not aged well thus far over the past couple months, because now we already just talked about Tesla laying off people. We talked about it actually. Well, actually, you know what? When was that? That was in April. So we had a Discord call in April actually talking about, it was mid-April. So I'll give it to him that he might not have known about that at this time or anything like that. And so, but by mid-April, he should have changed his tune. at least on April 10th. So not too far after this interview aired, by the way. It should be noted that, you would have seen a slowdown or a slowdown coming in Tesla as a company. Okay, I'm not contributing to that. My Tesla will arrive in July, hopefully, as long as they can get the materials to build it. But that's
living by $5,000 a year. And they have a moat that nobody can get around and increase production.
You can come up.
Oh, and also just like absolutely funny moment there that we're assuming that everyone can afford a Tesla. That's like a Stephen Colbert moment where it's just like, oh yeah, gas prices are high. Why don't you just buy a Tesla? Just telling the average consumer that, just buy a Tesla. Clearly, a Tesla is within everyone's price range, which is kind of, how do you say, out of touch. That's an out of touch comment right there. Now, we can all point to the other, well, whatever.
With the upfront, wait a minute, let me finish what I'm saying. The problem is a lot of people won't be able to afford to buy a Tesla. Or any car for that matter.
Oh, well,
the costs are going to go way up. They're going to be stuck with their old cars. In fact, you know what a lot of Americans are going to do? They're going to get bicycles. They're not going to be able to afford to drive their cars. They're just going to be riding around in bicycles.
Extreme, don't believe that.
Arcimoto. We have Arcimotos, electric bikes, electric three-wheelers.
This is the
growth
future.
Company.
But so I want to own companies where people are going to pay the higher prices. They're going to cut back someplace else. So I don't want to own the businesses that are losing.
Low key, if that scenario does play out, and something like Arcimoto, that they have all the opportunity to actually succeed, but if they don't succeed in that environment, then wow, what a trash company. But no, if let me be fair where fair is due, okay? So if we're in a scenario that people couldn't afford to use their cars, yeah, that could make an Arcimoto a viable investment, because they would have a lot of tailwinds. Yeah, that's true. That is true. Now, that scenario has to play out, because I don't think people would willingly love to choose an Arcimoto vehicle over a car, which is much more comfortable. At least as I'm getting older, I'm still young, but as I'm getting older, I'm starting to care more about the comfort of the vehicle rather than anything, and my quality of life in the vehicle. So I wouldn't really go for an Arcimoto. I leave the rough riding for the lake, but yeah.
Losing sales because their customers are spending too much on food. They're spending too much on energy. They're spending too much on insurance.
Yes,
and
the
rent
liquidity
and
crunch.
Taxes. They've got nothing
liquidity
left.
crunch.
And they can't borrow because credit's dried up and interest rates have
liquidity
gone up.
crunch.
And so this is the environment we're going to be in. But the best places to be are going to be outside the United States.
No.
It's the foreign economies, the emerging markets.
Depends.
They're going to do well. As the dollar sinks, those currencies are going to rise in relation to the dollar.
No.
So their cost of living is going to fall as the American cost of living rises. The stuff that we can no longer afford is going to be bought by consumers.
Okay, there we go. I disagree with him on that, because I looked at his portfolio here and there. It's a lot of Europeans. So Europe is a really, really sick place. They are far worse along the curve than the United States as a continent. We're discussing them as a continent. If I go by country, there are pockets of really good, well-run countries. Like Switzerland. This is actually the discussion I had with one of the subscribers. Switzerland, I would say, and I'm going to tell you, it's one of the gems of Europe, but it's not part of the EU. They still have their own currency. They still control their own monetary policy. They are like a special case, right? And so many of the most valuable companies in the world that we can name, let's name a couple right now. Nestle's from there. Juvedan's from there. Many of you probably have never heard of Juvedan, right? And that's a shame, because that's a wonderful company. So a lot of fantastic companies have actually come out of Switzerland, and you need to almost appreciate that. How did such a small little country, right, develop so much successful corporations, right? Why? Multinationals. We're talking about multinationals here. And, if we go into branding, I mean, come on, the watch game, they dominate. But you look at other countries specifically in isolation, and you just see, I don't know, just like something is just waiting for it to just collapse right there. We look at Spain. We look at France. France actually is getting worse and worse and worse. It's not there yet. It's not as bad as Spain. Look at Italy. Italy is kind of, you got northern Italy, so which, if we can isolate the regions, northern Italy is doing rather good, but it's kind of getting dragged down by southern Italy. And then you also have Greece, an obvious one. You have Portugal. Let's not forget them. And, the UK is hanging in there, but there's some cautionary things that might happen, going forward into the future. Germany holding strong. And so I'm just naming some of the major economies in Europe. So you have a lot of issues that are kind of going to manifest. And so I don't agree with Peter Schiff here. You look at the velocity of money in Europe, it's below the United States. It's declining. And they're doing the same exact strategy, the predictable strategy. So in order to kind of curb this, the government starts to increase spending more and more and more, and also begins to borrow and do more QE and all of the stuff that they're doing. Right? But the premise is the same. The prediction is still the same. Their long-term trend line is still the same. Right? It's not a good place to really invest in. What I want to add as kind of food for thought is that Peter Schiff's points are kind of correct. It does depend on what specific kind of company he's talking about. There is a company that at work we are acquiring within Europe, and we're acquiring shares, a decent amount of shares. We did stop because of a quote-unquote super investor got involved, and it shot up the stock price, unfortunately. But then it came back down, so then we're actually starting to reinitiate this week. Again, we're going to start buying again. I've already asked permission again. If you guys want to know what that stock is, comment down below, and I'll beg permission to talk about the stock. Or if anything, I'm going to talk about the stock, but I won't actually highlight that that's the company that I was talking about. It will just be like, oh, this is a company that exists, but with no context of this is what we were acquiring. So, again, no promises on that. If they say no, I'm not going to say that that's what we're doing. So I'll just talk about it, but you won't know among the ocean of companies that I talk about that is the one. You might guess because I talk about it favorably, but who cares? All right. So yeah, I agree.
In other countries. And so you want to own businesses that can profit
Yeah.
from selling stuff to wealthier foreigners. You don't want to get stuck with the businesses whose American customers are too broke to buy their products.
Ross Gerber, are you bullish international stocks? Can we get out of here on a limited point of agreement?
I am super bearish on international stocks. Everything you said, I completely disagree with. I think Europe's in severe issues now with their reliance on Russian energy, and the inflation issue and the stagflation issue is actually real for Europe. And I think that their economics and politics make it extremely difficult for
Hey, I agree with Ross on this. I agree with him on this.
companies to do well there. Where here in the
I agree with him. I don't know. Peter Schiff is kind of like a weird capitalist where he's like, or free market guy, because, Europe is not all parts of Europe. Let me be very specific. And a lot of people have weird assumptions about the Scandinavian countries, which is not necessarily the case. If you actually go there and visit there, or you actually look into their tax system or tax structure, it's really fascinating how they've decided to do it. But no, there are lots of parts of Europe. Yes, Ross Gerber is exactly right. It's very difficult. Family in Italy will tell me that it's nigh impossible to start a new business. It's very difficult. A lot of it almost seems like you must bribe. You must participate in the corruption that exists in Italy. It's unfortunate, but yeah.
In the United States, people have been getting massive raises on the low end of our society, on the lower income end. The average income and the average minimum wage here in Los Angeles has moved up to $25 an hour. People have more money, especially lower income people are all getting raises. We're literally competing for hiring. Like, we just offered somebody a job and they went back to their old employer, and then their employer gave them a raise, and then we said they didn't recognize this, we'll give you a little bit more, and then they decided to come back. When has that happened? And this is not a high level job, this is a low level job. So there's competition for wages, and people are making way more money, and they're spending.
Yeah, but they're not producing more.
So this is a really exciting time.
Boom. That was about what I was about to say. So that's the complicated nature of this topic. Just because people are making more doesn't mean that's a good thing, actually, because you could always have wage price spiral. So it's not a. Yeah, you want people to generate more in real terms. That's the key, real terms. But or stay stagnant in real terms, because it has to reflect the value produced by that labor. If that labor is earning more in value terms, let's say that the value is stagnant or the value is fixed. If it's earning more than what it produces, it's leaking out. Okay, so then something will give somewhere, and it's like a game of whack-a-mole, and you can't fight this nature. This is nature. This is not something that we can just complain about and say it's not fair. Well, it's just it's the way things will always be. Okay, it's not something that you can fight. Okay, people might wish we could, but you can't.
Earning more, but not producing more. That's why our trade deficits are exploding. This is all a fantasy.
No, because people are buying stuff. That's why it's exploding.
They didn't produce with money that we print.
Foreign.
This is a disaster. You just don't recognize it.
Well, we like wine from other countries and clothes from other countries.
Yeah, but
and toys
how do
from
we
other
pay for it?
countries.
We can't. We have to make stuff.
So, guys, you came for a spirited debate, and you absolutely got it. I felt like the referee in a heavyweight.
All right, so then we'll close it off there. Closing thoughts. I think both of them have interesting points. I think they both have differing arguments. I think they're arguing on the wrong battlefield, in my personal opinion. But there's a lot to be said. So if you guys have any questions, you can leave them down below. If you're not subscribed, go ahead and subscribe. On that note, this is part 2 of the Peter Schiff versus Ross Gerber debate, and I'll see you guys on the next one. Bye.